Good evening, guys. JR with Secure Metals Exchange, bringing you another technical look at both gold and silver. Today is the second day of July 2013. It is 6:44 p.m. Eastern Standard Time. So before I get into the analysis, I'm actually going to do some analysis today on platinum and palladium as well, which I normally don't do, but I really like those two metals right now. And before I actually get into those analysis, I'd like to share some of these articles with you. As always, the article links will be at the bottom of this page here. So just obviously you can just click on those links if you want to see the full articles. Don't let the mainstream media fool you and tell you that the economy is doing so much better than it used to, or so much better than it was back in 2008. This is a pretty good article here by zerohedge. Again, the link will be at the bottom. And 36 tough questions about the economy that everyone should be asking. Now, with each passing day, the debt of the Federal Reserve grows larger and larger. The financial world becomes even more unstable, and American families fall out of the middle class. The same long-term economic trends that have been eating away our economy like a cancer for decades continue to ruthlessly attack the foundations of our economic system. We are rapidly speeding towards an economic cataclysm, and yet the government and most of the media make it sound like the happy days are here again. The American people deserve better than this. And I'm not going to go through all the questions, but I'm going to go through a few questions that I think are pretty important here. Number one, if the percentage of working Americans that have jobs is exactly the same as it was 3 years ago, then why is the government telling us that the unemployment rate has gone down significantly during that time? I have the answer for that, and the reason why is because people are not necessarily getting jobs. People are just falling out of the workforce. All right. Another good question is number 4 here. Why is real disposable income in the United States falling as fast at the fastest rate that we have seen since 2008? Why do 53% of all American workers make less than $30,000 a year? Why are wages as a percentage of GDP at an all-time low? Why are 76% of Americans living paycheck to paycheck? And the good thing about this article is that it does have links to support everything that they are asking. Okay, so definitely check this article out. Very good article. Another article here by CNN here. 76% of Americans live in paycheck to paycheck, and that was actually one of the questions here. Another disaster that I see here in the future. 68 senators vote. Obviously, we all hear about the immigration bill that passed the Senate last week. 68 senators vote to create incentive for employers to hire amnestied immigrants over U.S. citizens. Not good, guys. As the Washington Examiner's Philip Klein recently reported, under the Obamacare, businesses with over 50 workers that employ American citizens without offering them qualifying health insurance could be subject to fines up to $3,000 per worker. But because the newly legalized immigrants wouldn't be eligible for subsidies on the Obamacare exchanges until after they become citizens, businesses could avoid such fines by hiring new immigrants instead. So definitely not the right way. And just a prime example that when government has two options, to do the right thing or to do the wrong thing, usually they pick the wrong thing. Okay. Another problem here: student loan interest rates double and Congress takes no action. Again, a lot of negative things out there, guys. And this is not even including all the political tensions, all the geopolitical tensions that we have around the world. So again, more and more reasons to own gold, more and more reasons to protect yourself against whatever is going to happen here in the next couple of years. I predict, again, a huge market crash and a huge dollar crash. But that's besides the point here. So are we at a bottom? So India, so gold premiums double in India as demand outstrips supply. Again, another great article here. I'll have the link below on that one. Is has gold found the bottom? Some of the I guess I'll point some arguments here in a couple seconds here on the technical analysis side, but this is very important. This is pretty good. This is the COT report for gold. Okay, and this is actually silver. This is actually gold right here. And what this actually tells us the net short percentage, the commercial net shorts on the market. Remember, producers have to hedge their production as the only way they'll be able to really lock their profits and protect themselves from any price fluctuation. So what they do is, if they're producing 100,000 ounces of silver, what they'll do is, or however many ounces of gold, they'll go on the future side and they'll hedge by doing the opposite. So if they're producing gold or silver, what they'll do is they'll go to the futures market and they'll hedge. And obviously farmers and any producers usually hedge. Okay, and as of right now, we are at the lowest we've been since 2008, since the last recession. So it seems that the miners are betting that the market is going to turn around any day now, because again, as we can see, this blue line indicates that when they hedge, the higher it is, the more they hedge, the lower it is, the lower they hedge. And as you can see here, that we are at a multi-year low. So it basically means that these miners are hedging less and less. And of course, we can't forget to mention that right now, trading at $1,250, where we currently are. We just went below $1,200 just a few days ago. Weren't there for too long. And again, $1,200 is really a key level, because $1,200 is really the cost of production. Anywhere between $1,150 all the way up to $1,250 is the cost of production. So any prices below $1,200 would immediately start sending mines to shut down, and at that point I would expect the prices to skyrocket because of lack of supply. And as we can see, there's plenty of demand here across the globe. So this is the short on gold. So again, at an all-time low, not an all-time low, I'm sorry, at a multi-year low. And on silver, this is your short again. Right now, we're shorting as much as we were, the lowest that we've seen since 1997, 1998. So again, as prices, this is the pink line would be the price of silver, and the blue indicator is how commercial hedgers are shorting the market in order to hedge their production. Okay, so as of right now, we are these commercial producers are not betting that the prices are going to continue to go down. They're actually at a multi-year low as far as their hedge is concerned. All right, another good article here by Citi. Okay. By CityFX Technicals. Again, you'll find the link at the bottom. And this is a good, I put this link here because this actually really goes back. My chart really only goes back to the late 1979, probably not actually to probably 1980. These charts go back all the way down back to 1970. And again, great case here of how we should be at the bottom here any day now. And really everything that you see here you'll find on my analysis, on previous analysis that I've done. So again, what they've done is they've measured all the dips that we've seen in the last 50 years and compare them to this dip here. And to make a long story short here on this article, it does say that these are the levels that we are looking to find a bottom, unless we have a dip similar to the one that we had in 1979 and 1980. Then if that's the case, then we might see 1050. But again, I think I noted on my last video that last time we saw this dip back in 2008, it fell just shy of the 61% Fibonacci retracement over here. Came down to 681 and again missed the 655 zone, which was again the 61% Fibonacci retracement, before it just took off. And right now, at least the last move that we saw last week, we came down to 1182, just shy of 1155, which was 61% Fibonacci. So I'm curious to see if we're going to see this low, if we're going to see something similar to what we saw in 2008, if we are going to see something similar than what we saw back in 2000 and in 1980. Then we can see a little bit more of a move to the downside, probably around probably around 1050. Okay, and so at this point here, and these are great charts, guys. I mean, this is what we're looking at. We're looking at a big move to the downside, and then of course the next leg up. Because again, at the end of the day, this is still a bull market, and right now we are at the 61% Fibonacci. I do expect these markets to go up extremely aggressive, and the one thing that I can tell you is that on all these moves that we've seen back here, and mind you, they've all been pretty big moves to the downside. And every time these moves come about, the gold bears come out of the woodworks, and of course they start making their case. But of course they've been wrong time after time after time. And again, this article here will go over all the different charts, coming back all the way to 1966. So we can see here that 1970 it took off right before it hit its high. It came down, and this was a drop of about 35-40%. Came up extremely aggressive, settled down for 20 years, and now here we are again. And we're looking at this move here, similar to this move here, worst case scenario. And of course, from here, we can continue to go higher, okay? So again, a very, very, very bullish chart, as we can see from the charts here, okay? And of course, now we'll get into the technicals. Gold right now, let's see here. This is the gold chart. I'll start off with the daily chart. So this is your long-term trend that's holding us up, at least right now. Again, we want to get above this line. It seems like we're trying right now. I don't know, in the next couple of days we'll see what happens, but the stochastics are still pointing to the high side, so still room to go up. And let's get out of this chart here. I'll clean this up a bit. So again, stochastics are at the bottom here at the week range. So again, we are looking for a reversal any minute now, any day now, of course. And that's on the weekly chart. Your 20-day moving average and 50 and 100-day moving averages are all above us. So we do need to get over this hump here. And of course, this line here, we definitely need to get above this line here. This is the line. This is one line here. And we also want to get above this line here. So this is holding support here at this line here. And again, if this line holds, then we'll be looking to move to 1300. That'll be the first target, and the next target is the 38% Fibonacci retracement. Now, if you do remember, a couple weeks back, there was a move, I think it was right here, where we saw gold go to 1300. It came up to 61% Fib level, and when we were here, I said that I expected the move at least at the 38% Fibonacci retracement, because again, these Fib levels are very, 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 very common, and they usually do the same thing. Very great. I mean, this is one of the best indicators that I love. And again, usually you'll see a move to 61 back down to at least 38%. Same is the case when we look at the long-term weekly chart, where again, as of right now, 61% Fibonacci, we're looking to trace back to at least a 38% Fibonacci retracement in the meantime, before we continue to zigzag and go much, much higher. But again, week range. As far as silver is concerned here, silver also looking very, very oversold, extremely oversold. Actually, the one thing that I forgot to mention here on gold is the RSI. All right, so the RSI tells you how oversold or how overbought something is. If you notice here back in 2011, this thing was extremely overbought. This was extremely overbought. So you had $85 here. I'm sorry, 85% here on this marker when this thing came up, and you saw a big dip down to 1700 from 19. Then from 19, it came, from 1700, it came back up to 1918 again, extremely oversold. And then you saw the big move to the downside. And we can see here that the last time we saw this thing, this oversold, was back in 2008. Actually, I'll put the weekly chart here. And last time we saw this thing oversold, at least in the weekly chart, was back in 2008. Extremely oversold. And as a matter of fact, this chart doesn't even show a time when this was as oversold as it is right now. Currently at 22%. And again, last time we were here, this was 21%. We went from 1321 all the way up to 1480 before continuing to go down a little bit further. So again, very, 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 very oversold. And now let's look at the silver chart here. The silver chart, I like it much more than I like the gold chart. Okay. The silver chart actually hit this support level here at around 1866. It actually fell below it. It went to 1830 for a little bit before coming right back up. And as of right now, stochastics are looking like it's going to come back here a little bit. It's going to come back here again, maybe down to 1870. We'll see if this will hold support again. But again, if it doesn't, then we'll be looking at the next support level, which is roughly around 1750. But from here, again, over the 61% Fibonacci retracement, I'd expect to move back to the 50% Fibonacci retracement, at least 50% Fibonacci retracement. Before the year is up, I expect $29 prices. If not by the end of the year, I would say the latest March of next year. But again, I do expect that by the end of this year sometime, we're going to see $29 prices and see this 21 Fibonacci retracement here, okay? I'm sorry, and go back to at least 50% Fibonacci retracement. All right. First, we do have to come across this 20-day moving average. 50-day and 100-day moving average are all above us. So we do need to go over these above those numbers. And as you can see here, this actually found support exactly where this trend line is here. And from here, again, like I said, I would think that this is at this point, this would be the bottom, but this thing, it's just, it continues to find new lows. But again, I do expect this to make an extremely aggressive move. As you can see on every move that we've seen in the past, every time we see these levels come in, the bulls come in and they just destroy the market. And the moves to the upside are actually much more aggressive than the moves to the downside. So I urge everyone right here, if you're looking at this chart, you have to look at the highs. The highs here and here. The lows are here and here. So again, you want to buy at the lows, you want to sell out at the highs, and any price around this area here is a great time to buy, I think. And again, first target would be to your 61% Fibonacci retracement, and then thereafter we'll be looking at $29 prices. Okay, so let me get into the platinum also. All right, guys, so this is your platinum chart right here. Platinum fell below this very important key level here on 1368, currently retesting this level here, and this level now is going to act as resistance. So again, if it continues to go higher, then that basically means that it's a false breakdown, and most likely the move to the upside will be very, very nice. Stochastics are getting to the weak range here, so it does look like we'll see a reversal. Now, mind you that platinum, the cost of mining platinum is a bit higher than it is gold. Gold is between $11.50 to $12.50. Platinum is between $12.50 and $13.50 or $1300. So again, last time we saw these prices, this was back in 2012. Again, you had a big move to the upside. Again, another big move to the upside. So anytime we come to these levels, especially right now, what we're going to see is we're going to see big support here. And as a matter of fact, the platinum holdings right now are at record levels, and so are palladium levels. Silver is down 5% from record holdings, and gold is down 22% from record holdings. Now, I would imagine gold is down more than every other metal simply because it's the most mainstream. So it's the one that you're going to hear more in the news. So when the metals fall, even though they fall within a positive correlation, you just hear gold and gold and gold, and people get a little nervous. They sell off their gold. But again, platinum is really I think last week it hit its all-time high in platinum holdings. Palladium also trading at its all-time high. Not trading. Right now it's at its all-time high when it comes to palladium holdings as well. Silver is down 5% from its all-time holdings. And that's based on the ETF. So again, production cost, guys, we're basically at production cost when it comes to all these to the PGMs as well as the gold market. Getting close to it on the silver market as well. Even though silver is a little bit less, silver the mining cost for silver is anywhere between $8 to $12, depending on the mine and so on. And of course, the technical charts do suggest that we're going to see a bottom here any day now. The gold premiums doubled. So again, guys, great time to buy. This is the time where you want to buy. If this thing continues to go down, remember what I said before in my previous video. If this continues to decline, the Fed will have no option but to continue to print. Their goal is 2% inflation. Right now, we're at 1% inflation. So I don't see any tapering anytime soon. I expect prices to continue to move much higher, much higher. And before I go, I'll show one last video. The reason why I put this video is because, again, I found it funny. They always put the bulls versus the bears. And I found this funny because they both ended out to be bulls.
Tom McClellan, editor of the McClellan Market Report newsletter, who joins us on the CNBC Newsline. Thank you both. Jim, let's start with you because I'd like to hear the case, I guess, for buying gold at these levels.
Well, it all depends on Fed policy. The reason gold has been going down lately is because the Fed has been tightening. You have basically real interest rates have gone from about 70 basis points negative to 50 basis points positive. That's a 120 basis point increase in real rates. Gold likes negative real rates. In other words, when inflation is higher than the nominal rate. What's happened lately is inflation has gone down, nominal rates have gone up, real rates have gone steeply positive, and so that's bad for gold. So if you say if the Fed continues the tight policy, then gold will continue to trade down.
But wait a minute, Jim, what's the case for buying? Because you're bullish gold right here. So what's the case for buying gold right now?
The case for buying gold is that the Fed's going to back off. They're not going to taper. Later this year, they'll actually increase purchases because deflation is winning the tug of war between deflation and inflation. Deflation is the Fed's worst nightmare. So in the next 2 months, the Fed will make it clear they're not going to taper. They'll increase purchases later this year. They'll try to get negative real rates, and that's very bullish for gold.
Tom, we know you like to put charts on charts, look at price patterns. You've actually, at the request of one of your readers, tried to do this between gold and what stocks did in the '09 lows. What does it tell you?
Well, it's a fascinating comparison. What we see in any charts is the personality of the people trading whatever is being looked at, and what we're seeing in gold is the same pattern of the decline and just in the last 2 years that we saw in the stock market from 2007 to 2009. It's the same emotional play that's going on. People falling out of love with stocks back then, people falling out of love with gold now, and we're reaching the climax point equivalent to the March 2009 low for the stock market.
That chart that we just showed, Tom, suggests that Jim might actually be right, at least in the near term.
There are lots of reasons to be in love with gold right now. The biggest one is that everybody else seems to be falling out of love, and nobody seems to like it. The commercial traders, if you look at the Commitment of Traders data, the commercial traders are at their most bullish stance since the 2001 low, and they usually get proven right. It may take a week or two before that starts to matter, but it's a really hugely bullish condition for gold, and I'm expecting a really large rebound.
That may be the case, but how do we know when we've put in the lows? Because obviously everyone would have loved to buy in the right time in March 2009. How do they know when is the right time to buy here?
Well, the right time to buy is when the Fed starts easing up. Right now, they're tightening monetary policy. That's the most important thing. They can't do that. Deflation is their worst nightmare. They've got to loosen up. Look, I own gold. I buy gold. I recommend it for clients. Not more than 20% of your investable assets. The destination for gold is $7,000 an ounce. But if the Fed continues to tighten, it could trade down to 1,000 on its way to 7,000. That's important for investors to know.
7,000. Tom, you want to comment on that?
I can't construct a target that high. I got upside targets of between 2,800 and 4,400 based on some technical studies. But we could get to 7,000 maybe later. But the biggest reason, the thing that we haven't had yet, we haven't had that Orange County, California blow-up moment like we had in the 1994 bear market in gold. Orange County, California went bankrupt, and that marked the low for bond prices. The moment that we see a big major gold producer announcing that it's curtailing production or it's going out of business, that'll be the moment that we mark the low in gold, and I expect to have one of those announcements any minute.
Well, in some ways, if it's a gold producer, that's more favorable than if it's someone on Wall Street, say?
Yep. Well, we're getting...
So again, guys, very, very interesting. What we have is we have a market that's very, very, very bullish. As we can see here, analysts across the board here are giving gold much, much higher gold and silver prices. As I've said before, the Federal Reserve is trying to fight deflation. They're not trying to create deflation, and that's what they're getting. So again, I do expect prices to go much, much higher. One guy, again, you heard him with a target price of 7,000. Another one with a target price of 28 to 4,400. I think what we need to do is I think we need to surpass 2,000 before we start putting out those numbers. But the technicals do suggest that that's what we're going to see. So again, I think I did an analysis a few years back where, again, my target was around $5,000, $5,000 on gold. But again, point being that 20% of your investable assets need to be in precious metals. Whether you like it or not, this is the only insurance policy that you can take out on your wealth. No matter what happens, your gold will always protect its own purchasing power. So really what you have is you have a small percentage, whether it's 5, whether it's 10, whether it's 15, whether it's 20. You have a small percentage of your investable portfolio in precious metals. Diversified within gold, silver, platinum, and palladium. And again, we're just going to see more and more printing. There's, as we can see from these articles, guys, there's nothing out there suggesting that what the government is doing or what the Federal Reserve is doing is working. 76% of Americans living paycheck to paycheck. These student loans doubling. Interest rates on student loans doubling. Unemployment not going anywhere, $17 trillion in debt. This is what we look at when we buy gold, and this is why we hedge ourselves against inflation. This is, we're living in bad times, a lot of geopolitical tensions. I haven't even gotten into that. I can on the next video. But again, right now we have problems in Syria, Turkey. We have social unrest in Turkey, social unrest in Brazil, social unrest in Spain, social unrest now in Egypt. We're financing rebels, supposedly for humanitarian purposes. And what these guys are doing is they're beheading their enemies. It's disgusting what's going on. And again, hedge yourself against inflation. Buy at the lows. These are the lows. And let's take profits here at the highs. All right, guys. I hope you enjoyed the video. Have a great one. Bye-bye.